Hi everybody, Thomas here. A couple of months ago on this channel we looked at semiconductor giant Nvidia. With the new set of earnings and financial data on the books and the stock not far away from its all-time highs, it's a great time to check back in and decide if Nvidia stock is just too expensive to be anything but a sucker's bet. The answer actually might surprise you. Let's check it out. Nvidia's stock has been following a very long-term upward trend that has really accelerated throughout 2023. It's been one of the biggest winners in the stock market. We can see that overall very long-term trend is reflected by the rising 200-week moving average that we have on my chart. The 20-week moving average in the meantime has really accelerated with the stock's acceleration in price. It's lifted away from that 200-week moving average. We can see it pushing very, very high up here right now. The stock peaked just a couple of weeks ago, up a little bit above $500 per share, and has been dropping back a little bit over the past couple of weeks from that point. Under normal circumstances, for a contrarian value hunting investor like me, this kind of pattern is actually pretty scary. This is something that I would generally dismiss out of hand because the stock is so extended. It looks like that upward trend certainly should begin to reverse at some point. Is this current decline in price that retracement, that drawdown in price? Or is it simply one more opportunity to buy the dip? The interesting thing about this is the way that the stock has rallied over the last year with strong support right around the 200-week moving average at around $450. So this is a stock that is very extended in price. It defies some of the traditional kinds of patterns I like to look for, bullish level 1, bullish level 2, that usually fit into the kinds of downward trends that I like. But the way that the 200-week moving average has begun to decelerate and even begin to flatten a little bit lately does suggest that it could be at a point where it will begin to stabilize, possibly consolidate. Often those create new opportunities if the long-term trend is going to remain in place for the stock to rebound and accelerate into another new upward trend. This does look very extended, but at the same time is also a little bit intriguing if you're a bullish-minded investor. The real next question then is whether or not the company's fundamentals support the stock's elevated price. The basic assumption most value investors make when they see a stock that is as extended as this one is that the stock will most certainly have outpaced the company's ability to grow its business. That's not always the case, though. So let's dive into Nvidia's fundamentals and let's take a look at the numbers, because I think that you might be surprised by what we see. Nvidia's fundamentals are very healthy across the board. We can see their free cash flow has accelerated dramatically over the course of the last 12 months from $3.8 billion to $17.5 billion in the last quarter. That also includes a $7 billion increase from $10.3 billion just from the quarter prior to the most recent. This is a company that is one of just a few trillion-dollar market cap companies, and that is why the free cash flow yield, despite these improving free cash flow numbers, is still only about 1.5%. That's modest, but the overall free cash flow growth remains very impressive. In addition to growth in free cash flow, we can see that cash has also been improving nicely from about $13.3 billion a year ago to just a little under $18.3 billion in the most recent quarter. This provides the company with excellent liquidity, especially when you realize that long-term debt has actually been going down from $9.7 billion a year ago to its current level at just a little under $8.5 billion. So the company has more than enough liquidity, could liquidate all of their long-term debt right now and still have plenty of cash in the bank. One of the strengths that Nvidia has demonstrated consistently over the last few years is its above-average operating profile. We can see that reflected in our net income measurements. Over the last 12 months, net income was a little over 42% of revenues. That's extremely high, very, very healthy. The really interesting thing is the fact that this number increased to 51% as of the most recent quarter. This is a very strong confirmation of the growth we're seeing in free cash flow, in cash and liquid assets, and it certainly implies that Nvidia continues to expand their operating profile. They're continuing to remain at the top of their market, claiming major market share, especially in the AI and cloud computing space over the last few years, as well as their already existing dominance in the world of cryptocurrencies and graphics interfaces. Despite all those strengths, the one complaint that I have is in their dividend. Company pays only 16 cents per share per year, which is not even worth talking about in terms of an overall dividend yield. And certainly given the numbers that we've just seen in terms of free cash flow and cash, they could certainly afford to raise their dividend and return some additional value back to their shareholders if they chose to do so. All that said, though, the really interesting element here is that despite the stock's elevated stock price, it does still look like an interesting value with about 17% upside from its current price at about $468 per share. We've got a fair value target just a little bit below $550 at $547 per share. So this is very interesting considering the way that the stock has been moving for the past year. With all that in mind, let's go back to our charts and let's take a look at those technical setups and think about those potential entries in terms of reward to risk. As I previously mentioned, the stock's major resistance is right at its all-time highs, which sit at around $500 per share. The stock has been retracing back off of that, is a little over $30 below that point, or not quite 10% considering the stock's current price. That current drop begs the question of where support should be. The easiest way right now to look for expected support is from the 20-week moving average at about $450 per share. That means that from the stock's current price right now, there's about $18 of potential downside. With the stock dropping over the last couple of weeks, it looks like it may be more likely to visit $450 than to reverse back and push back up towards $500. What if it breaks below $450? How much further down could it go? The next most logical way to identify where next support should be is based on the stock's previous pivot lows. We see those in the neighborhood of $400 with multiple pivot points during the summer as well as in the fall months of this year. With the stock so near its all-time highs, these first and second levels of support also provide a reference for how far the stock could rally if we see it push above $500. And in that case, the potential upside I would expect to see if we do get a push above 500, should probably be around $550 per share. With all of that in mind, we can start to talk about reward to risk. With the stock at around 467, let's just go ahead and talk about what the potential opportunity is up to immediate resistance. From $468 to $500, there is a $32 difference. Support is at $450, which is about $18 away from the stock's current price. At these current numbers, $32 of upside compared to $18 of downside, we're a little bit below the 2-to-1 reward to risk ratio that we would normally be wanting to look for. So if you're thinking about Nvidia in terms of placing a short-term trade, I would say that it's probably not an ideal setup right now. However, when you put these numbers in context of a longer value-oriented play, understanding the stock has about $17 of upside to that fair value target at around $550, this certainly does change the overall reward to risk profile. So I'll go ahead and call this value reward to risk. I'm going to take $550 away from $468, and now I have about $82 of upside against $18 down from the stock's current price down to current support. That changes the overall profile significantly and certainly argues very much in favor of Nvidia as a strong value-oriented opportunity, just from a technical perspective. With the fundamentals in mind that we've just outlined then, it's really easy to call Nvidia right now a very nice buy. Thanks for your time, everybody. I hope you found this to be useful. If you like this video, you like my content, please go ahead and subscribe to my video by clicking on the link on this side. You can also click here to learn more about the Rebel Income system that I use. If you'd like to receive reports about the stocks that I follow for the Rebel Income system and the trades that I place, you can also check out my Patreon page. The link is in the description for this video. Thanks again, everybody. I'm Thomas for Rebel Income. Talk to you again soon.